Welcome back. Today we're going to be joined by James Gautheir. He's the Chief Investment Officer at Justwealth Financial. And we're going to talk about the nuances of investment. Investments themselves, for sure, but financial planning as well as trading. James, great to see you again.
Hi, Pat. Good to see you as well.
Okay, James, let's start with the broader brush, if you will. What do you consider investments and how do you look at them?
Okay. Uh, Probably easy to start with an example of what investing is. So let's say you and I are sitting together in a bar, and you say to me,
We've done
I've
that.
got this. Yeah, it's true. So you say to me, James, I've got this great idea. I want to produce these wonderful new products that I think are going to make tons and tons of money. Problem is I need to build a factory and I don't have any money. Well, I can say to you, well, Pat, I've got all this money under my mattress and I don't know what to do with it. How about I give you that money? You can build your factory, and in exchange, we'll split the profits 50-50. Does that sound like a deal?
Sure. I came up with the idea. I'm building it, but it's still 50-50. Okay. I'm no judgment
50-50.
on fair here, but yes. Okay. Go on with your argument.
Okay. Well, that is basically the same thing as buying shares in Apple. I'm exchanging capital for a return of sharing profits in the company in the future. I'm taking an ownership stake, and that is an investment. I'm doing something with idle capital. I'm giving it to someone who needs capital in return for a share of profits. That's just like buying common stock equity. Uh,
Okay. Except that you now have to deal with the stock market. In the case of Apple, for instance, people would look at that investment and your co-ownership is the way you're just describing it. And then they'll say, okay, how does the value get surfaced in Apple? How do you value what's there?
that has become the evolution of investing.
Mhm.
So, yeah, working with a friend as opposed to buying stocks on the market, it's a little bit different. It's bigger
Yeah.
scale. So, Apple doesn't have one co owner, they've got millions. So, there is a process behind investing and valuing stocks. But we didn't talk about the other type of arrangement that we could have. So, let's say I wasn't quite so keen to take a risk because your company, despite your great ideas, it might never make profits. It might go bankrupt. It might never make a cent, and I would lose all of my money that I gave to you. So, what we could do is strike a different type of arrangement where I could say, well, Pat, I'm willing to give you money, but I want it back in 2 years' time. And in exchange, I'm going to give you $100,000, but when you pay me back in 2 years' time, I want $110,000. And in the meantime, hopefully you have all great success and everything works out. That is the same thing as buying a bond, where you're given a fixed rate of return and your money back at the end of a specified time period. So, for those people that aren't willing to take quite as much risk, there's the option to invest in bonds.
Okay, so now we've covered stocks, commonly called equities, and bonds or fixed income. So you've got both ends of the spectrum. When you look at your investments, though, and let's just stick with stocks for the time being, how do you look at them? Do you look at things like earnings or and that would be a quote unquote fundamental investor, somebody that's looking and focused on earnings and those kinds of valuations? Or do you look at just the price? You look at the price is going up, the price is going down, and that and many people would call that technical investing because you're just looking at the charts. How do you go about it?
Yeah, so what you're describing is standard reading for any course in finance. It's fundamental analysis or technical analysis. Everybody who becomes an investment professional has to learn about those things. I don't look at either of them. Both of those schools of thought imply that you can somehow use formulas or algorithms or other types of uh, you know, methods to be able to try and make money better than what the market can make. I tend to look at what has evolved to be known as evidence based investing, which says neither of those things work. Nobody can use those uh, processes to be able to add value to what the market itself delivers. So empirical evidence, academic evidence both say fundamental investing doesn't work. Technical analysis does not work. So I don't look at either of them.
Okay, what is evidence-based investing?
Well, you interviewed Robin Powell on the podcast, I want to
Mhm.
say a year and a half, 2 years ago.
Yep.
He gave a full explanation of what it is. So it's basically taking, here's a look at what people say. People say a lot of things. They claim a lot of things. You can create formulas. You can say whatever you want without having to provide facts because it's not regulated. But evidence based investing takes a look at empirical results. What has happened, not what you think is going to happen, what has happened. And if you take a look at, how fund, as an example, how mutual funds compare to the performance of an index over long periods of time, more than 90% of mutual funds do not beat the standard benchmark index. A lot of that has to do with fees, but it's just a proof statement that says fundamental or technical analysis, whichever one they're using, it does not work. And that's evidence to say it's proof.
Okay. So what you're describing to me is instead of looking forward with your investments, future earnings, future price movements, you look backward. What's it done already?
Nope. Looking backward is technical analysis, right? That's when we're looking at prices and trying
No,
to
but if I look back, I
extrapolate.
can look back on earnings, and the earnings have been growing at 5% a year, for instance, or pick any number, and that's my backward look. I'm not saying they're going to continue to grow into the future at 5% a year, or am I?
I think you are. You're
Uh,
saying here's what it's done, so that's what I should expect. So you're taking the past and naively saying the same thing about the future. And of course, any performance disclosure you read about, whether people are posting fund returns or an individual company's returns,
hmm,
it'll say past performance is no guarantee of future performance. That's a
that's right.
regulatory. So there's a reason for that. It's because what has happened is not what's guaranteed to happen in the future.
Okay, so then with your approach, what kind of a timeline uh, do you recommend when people are looking at investing?
So everybody's got their own timeline. I would say the timeline is individual based. There is no universal. You need to look at 10 years or 20 years. Everybody is going to have their timeline for their purpose. So whether it's retirement, whether you're saving for a house in 10 years or a car in 2 years, that becomes your timeline. So everybody's going to be different. And, as a portfolio manager, I have to talk to these people and understand what their timeline is. And then we can, plan their investments accordingly.
Yeah. What do you find with most of the people that you're talking to? Are they planning 2 years down the road and being, and I don't care whether you're buying a car or a house, or are they taking into consideration that the more important investment might be 30 years down the road in your retirement?
Yeah, it all depends on their individual objectives. So for those people that are looking at a purchase of a big item, whether it's a car or a cottage or a house or whatever, they tend to be shorter term in nature. People don't plan 30 years for that. But for somebody who's talking about retirement, who's earlier in their work career, they can be planning a long term time horizon. And we would always tell anybody, no matter what your objective is, what you're trying to save up for, always focus on the end of when you want to accomplish that, whether it's retirement and you have to eventually decumulate or buying a house in 5 years. Your time horizon then becomes 5 years. You always extend your time horizon to the end of your goal.
Okay, so that seems to naturally move, if you're looking at personalization of investments, it moves into the whole concept of financial planning. What are your thoughts?
Yes, that's the perfect word. I mean, financial planning is an evolution of investing.
Hmm.
So investing is, how do I get a return on my idle capital? How can I grow it? Versus financial planning, which is about how do I make sure I have enough money to pay for what I need in the future? So you go from a smaller concept, how do I make money on my capital, to how do I make my capital last for the rest of my life. So there is a distinction between the two. It's very different ways to evaluate how to accomplish the objective, but one is a natural extension of the other.
Yeah, it's almost like financial planning sets the table and investing is actually sitting down at the table.
Yeah, yeah, very much so. They're related.
Yeah, yeah, no kidding. Um, how do you lay out, what do you recommend to people, I guess, is the real question, when they're doing financial planning? Do you ask them to make a list of what their objectives might be down the road, or do you take a different approach?
So financial planning is all encompassing. It's investing is very focused on the investment you're talking about versus financial planning is all of your cash flows and incomes, including pensions and other factors that are not considered with an individual investment. So there's a lot more input into the analysis that you do. So age is obviously important. You have to make some assumptions. When you expect to die, when you expect to retire, what kind of lifestyle you want in retirement. So, are you going to spend 80% of what you're currently spending when you're have a mortgage and you're at a different point in life, savings for kids' education, whatever? So, there's a lot more analysis over time that you have to think about when it comes to financial planning, and it all goes into basically, a big spreadsheet, and the analysis is all mathematical. How do things flow over time? And ultimately, you ask the question, am I going to run out of money before I die or not?
Yeah, yeah, no kidding. The thing about financial planning, quite frankly, is every time I've looked at it or been involved in it, y- the end result was a budget. You know, you got to save this much money, you got to do this, you got to do that. So my question is, how flexible is financial planning? Because I'm not really good at budgets, to be honest, and a lot of people are not. How flexible is financial planning?
It's pretty flexible. I mean, it's we would say to everyone, you should revisit your financial plan every few years because you are making a lot of assumptions. You're assuming that you're going to stick to your budget, for example.
Yeah.
And if you don't, you're going to go off plan. But other things will come up as well. So, maybe you figure I'm going to retire 5 years earlier than I thought before, or my investment gains have done really well because I invested with Justwealth, and now I can retire earlier. There's all kinds of inflation is way higher than what we expected. So things never go perfectly according to plan. And that's why you need to come back to it every few years and make adjustments. I'm going to retire earlier. What does that mean? Do I need to save more now? Do I need to spend less in retirement? Any one of those scenarios, you can isolate and figure out what that means from a saving perspective right now.
Yeah, I figured it backwards that way. You know, I asked about flexibility because a lot of people think about investments as trading, getting into the stock market, getting out of the stock market, and doing that kind of stuff. And as a professional, I guess you kind of do that. But by the same token, there is a downside to taking that approach, isn't there?
Well, yeah, when you think of trading, I mean, trading can mean a lot of different things.
Hmm.
But trading, when we talk about, I'm a professional trader. Traders are if financial planning is the evolution of investing, trading is the devolution of investing. So it takes things the opposite way. It focuses away from longer term objectives, becoming to more like how can I make money? How do I make money now? How can I get rich quick? What can I do to make a buck right now? It takes the focus to be very, very short term. And it effectively becomes the exact same thing as gambling. And we all know who wins in gambling in the long run. It's the house. Investors will eventually get ruined. So trading is not the way you want to go. And there's so many people out there that believe that they can make money. I've got this method, I've got this process. It can't fail. Eventually it will fail.
There's a school of thought in the investment world on active investing. The whole mutual fund industry was founded on active investing. In other words, somebody knows better than you how to invest. And as you pointed out at the very beginning, mutual funds traditionally have not done as good as or at least most mutual funds have not done as well as the indices out there. Active investing um, is parallel, in my mind, to trading. In other words, they are going to move their assets around. And maybe it's not on a day-to-day basis. Maybe it's on a month-to-month basis. Am I correct in making that assumption?
Yeah, absolutely. So the way that active investing, it involves making bets against the market. You're always trying to figure out, how can I be better than the market? Well, to be better than the market, you have to be different than the market. And whether you're being really different or a little bit different, or moving around really fast or moving around really slow, based on whatever theory it is that you have that's going to be better than the market, in the long run, the evidence-based investing clearly proves it's not going to work. So part of it has to do with the fact that, I mean, the market is just too efficient. Uh, there are so many people, so many smart people, so many companies, so much money involved with the market for any one person or one company to think we're going to be smarter than everybody else. Everybody thinks that, and they can't be. On average, they have to be average, which is the market. So, I mean, it's a fallacy that you can try and add value. But the other angle is, because you're human, you're going to make mistakes. There is a field of investing called behavioral finance, or a field of finance that's more about, how do investors make mistakes? Why do investors continually make mistakes?
Hmm.
And trading, when you extract it that way, that's where you see the most mistakes. And so I got a little quote from Terence O'Dean, who was a behavioral finance professor, very well known. He created a study a few years ago and wrote a paper on it. And this explains, it summarizes the behavior of individual investors. So I'm just going to read it. The conclusion: in theory, investors hold well-diversified portfolios and trade infrequently so as to minimize taxes and other investment costs. In practice, investors behave differently. They trade frequently and have perverse stock selection ability, incurring unnecessary investment costs and return losses. They tend to sell their winners and hold their losers, generating unnecessary tax liabilities. Many hold poorly diversified portfolios, resulting in unnecessarily high levels of diversifiable risk, and many are unduly influenced by media and past experience. Individual investors who ignore the prescriptive advice to buy and hold low fee, diversified portfolios generally do so to their detriment. So that's a pretty strong proof statement by a person who has no incentive to tell you otherwise. He's presenting findings, it's unbiased, as opposed to marketing material, which you come across, which is biased. And they're the ones that say our active management will add value.
So, in summary, then, James, come up with a financial plan, do your investments that way, avoid the temptation of trading.
Perfect advice.
Let's leave it there. James, great to talk again.
Likewise, Pat. Thank you.
James Gautheir, Chief Investment Officer, Justwealth Financial.